Welcome to Blackmore Capital's Investor Update for July 2020. This investment presentation is given by Bogdan, Chief Investment Officer of Blackmore Capital. Turning to slide 1, I would like to draw your attention to the disclaimer at the beginning of this presentation. Turning to slide 2, the agenda today is the stock market investment clock, value momentum indicators. 2, the current EPS recession and earnings outlook. 3, a decade of policy rate cuts and the search for sustainable yield. And 4th, portfolio construction and risk-adjusted returns. Turning to slide 3. Where are we in the investment cycle? When the ASX 200 peaked on the 20th of February 2020, the Australian stock market was firmly in the top left quartile. Momentum was good, value poor. The ASX 200 was trading on a 12-month forward PE of 18 times, 25% above its long-term average of 14.3. Fundamentals were stretched, with earnings downgrades accelerating, reflecting a weakening domestic economy. Our portfolios held overweight positions in consumer staples and healthcare, firmly tilting the portfolio to earnings quality and balance sheet strength. Turning to slide 4. Fast forward to the 30th of June this year, and the ASX 200 was down 18% from its February peak. Turning to slide 5. Today, the ASX 200 is again trading on a 12-month forward PE of circa 18 times, based on the assumption of a 20% decline in market EPS for FY20 and a 10% recovery in FY 2021. Thus, we've returned to the point where momentum is good, underpinned by monetary and fiscal support, and valuations remain historically high at 18 times. Portfolio active weights continue to reflect the prominence of defensive growth and balance sheet resilience. Turning to slide 6. The current EPS recession. ASX 200 earnings peaked in September 2019 at $110 billion. Initially, Australian EPS began to decline due to the weakness in the domestic economy. More recently, the COVID-19 pandemic has accelerated EPS contraction. We forecast the peak to trough decline in EPS will be around 30% for the cycle, with a decline of 20 to 25% in FY20. By way of comparison, during the global financial crisis, the ASX 200 EPS fell by 31% and dividends by 33%. Turning to slide 7. We forecast a low in the profits for the ASX 200 in September 2020, with a return to the previous peak profitability not occurring until sometime in FY 2022. Thus, a 2 to 3 year round trip for profits to normalise. Encouragingly though, downward earnings revisions have appeared to have peaked in March and April this year. From a low of 80% net EPS downgrades in April, net EPS downgrades were only 15% in June 2020. And at the end of the last financial year, Australian net earnings had turned positive after 2 years, providing an important ballast for future valuations. Turning to slide 8. Purchasing Managers Index indicating a solid bounce. The Purchasing Managing Index are also showing signs of recovery, with the US ISM New Orders Index confirming a turning point for the economy. A reading of 56.4 for June was above expectations and consistent with solid growth. Moreover, Australia's PMI rebounded 9.9 points to 51.5 in June, highlighting the relative shortness of the current downturn in manufacturing. Turning to slide 9. A decade of policy rate cuts and the search for sustainable yield. Undoubtedly, risk assets have been a beneficiary of a concerted effort by central banks to provide liquidity and cheap capital to markets for over a decade. Since the GFC, central banks have eased monetary conditions to deal with crisis after crisis, where they have been effective in crushing the yield on major assets. A portfolio which is evenly split between bonds, cash, property and Australian equities would have yielded 4.5% in 2006. Today, this same allocation provides a meagre 2.2% yield. Turning to slide 10. Meanwhile, income-seeking investors in Australian shares are currently weathering the biggest dividend cuts in almost 50 years, led by the Australian banks. Our preference has been for an equity income strategy that considers dividend sustainability and momentum in addition to dividend yield. Our preferred dividend stocks currently include BHP, Coles, Chorus, Spark New Zealand, Waypoint and Wesfarmers. We expect these companies to generate faster dividend growth than the banks and to provide a total shareholder yield, dividend yield adjusted for capital raisings, more than the banks. Collectively, the dividend yield of circa 4% in FY21 remains an attractive source for income investors, particularly when you can add back the franking credits. Turning to slide 11. Earnings quality and balance sheet strength remain of paramount importance. We retain relatively a defensive portfolio with a cyclical exposure tilted to resources with strong balance sheets. We remain overweight defensive growth across consumer staples, Coles, Wesfarmers and Woolworths, industrials, Brambles and Cleanaway, and healthcare, CSL, Healius and Ramsay. Turning to slide 12. Blackmore Capital's portfolios have consistently delivered top quartile performance measured by both return and risk. This concludes today's investor webinar. Thank you.